Welcome back to Swadhyay. We have revised the definitions of previous year, assessment year, who is a person, and how we compute total income in the previous videos. In this video, let us revise the tax rates applicable to various assessees. First comes individual HUF, AOP, body of individuals, or artificial juridical person. For these assessees, they can either pay tax under default tax regime under section 115 BAC at concessional rates, or they can pay tax as per the normal provisions of the Annual Finance Act. Coming to the default tax regime under section 115 BAC, the concessional tax rates are as follows. Up to the total income of rupees 3 lakh, no tax is charged, that is, the tax rate is nil. For the total income from 3 lakh to 6 lakh, the tax is charged at 5% on the amount exceeding rupees 3 lakh. I repeat again, guys. For the total income from rupees 3 lakh to 6 lakh, the tax is charged at 5% on the amount exceeding rupees 3 lakh. It means if total income of an assessee is 5 lakh, the tax is charged on 5 lakh minus 3 lakh, that is on the amount of rupees 2 lakh. 5% tax is levied. Similarly, coming to the next slab, that is if the total income exceeds rupees 6 lakh and is up to rupees 9 lakh, the tax is levied at a rate of 10%. For 9 to 12 lakhs, it is 15%. For 12 lakh to 15 lakh, it is 20%. And if the total income exceeds rupees 15 lakh, the tax rate is 30%. Once again, let us repeat these tax rates. Up to 3 lakh, no tax is charged. It is nil. From 3 lakh to 6 lakh, the tax is charged at rate of 5% on amount exceeding 3 lakh. Similarly, if the total income exceeds rupees 6 lakh and is up to rupees 9 lakh, the tax rate is 10%. For 9 lakh to 12 lakhs, it is 15%. For 12 lakh to 15 lakh, it is 20%. And if the total income exceeds 15 lakh, the tax rate is 30%. So these are the tax rates under default tax regime under section 115 BAC. But to pay tax under the default tax regime, the assessee has to forego few exemptions or deductions that are otherwise claimable as per the normal provisions of the Annual Finance Act. So that means the assessee cannot claim certain deductions or exemptions if he pays tax under the default tax regime, that is under section 115 BAC. Let us go through what these deductions or exemptions which are not allowed to be claimed under the default tax regime. First, let us go through 6 exemptions which are not allowed, and try to remember these 6 as LHS DMs. LHS DMs, left hand side of DMs. Okay. These exemptions are L for leave travel concession, house rent allowance, exemption in respect of special allowances or benefits to meet expenses relating to the duties or personal expenses, that is LHS. Leave travel concession, house rent allowance, and special allowances or benefit to meet expenses relating to duties or personal expenses. Then comes DMs. Daily allowance or constituency allowance of MPs and MLAs. Exemption in respect of income of minor child included in the income of parent. Tax holiday for units established in SEZ. DMs. Daily allowance or constituency allowance of MPs and MLAs. Exemption in respect of income of minor child included in the income of parent, and tax holiday for units established in SEZ. Now, coming to the next deduction, which is not allowed under default tax regime, it belongs to the head salaries. Under the head salaries, as per the normal provisions of the Act, entertainment allowance and professional tax are allowed as deduction. But under default tax regime, the entertainment allowance and professional tax are not allowed to be claimed as a deduction or exemption. Okay, under the head salaries, as per the regular provisions, entertainment allowance and professional tax are allowed as deductions or exemption. But under the default tax regime, entertainment allowance, professional tax are not allowed to be claimed as deduction. Then let us go to the next head, that is house property. Usually under the head house property, we claim deduction of interest on loan in respect of self-occupied house property. But under the default tax regime, we cannot claim interest on loan in respect of self-occupied house property as a deduction. I repeat, for only self-occupied property, if we pay any interest on loan in respect of that property, we cannot claim it as a deduction under section 24B. Next comes the head PGBP. Usually, we claim additional depreciation under PGBP as a deduction. But under default tax regime, additional depreciation is not claimed. Along with that, any investment in linked tax incentives for specified business is also not allowed to be claimed as deduction. Coming to the next point, deduction in respect of contribution to notified approved research association or university or college or other institutions for scientific research. Approved Indian company for scientific research, notified approved research association or university or college or other institutions for research in social science or statistical research, an approved national laboratory or university or IIT or specified person for scientific research under approved program. If we make any contribution to these research associations or company for university or college, the 4 points mentioned above, the institutions which are mentioned in the 4 points above, we usually claim them as a deduction under normal provisions of Act, which is not allowed to be claimed as deduction under the default tax regime. So, under the head PGBP, we cannot claim additional depreciation, investment linked tax incentives for specified businesses and such contributions under section 35 under the default tax regime. Also, under the normal provisions of the Annual Finance Act, deductions under Chapter 6A are claimed. But under default tax regime, deductions from 80C to 80U that are mentioned under the Chapter 6A are not allowed to be claimed. But there are exceptions. There are 3 deductions which can be claimed under the default tax regime. They are employer's contribution towards NPS under section 80 CCD clause 2. Central government contribution towards Agnipath scheme and deduction in respect of employment of new employees. These 3 deductions can be claimed under the default tax regime. The other deductions from 80C to 80U are not allowed under the default tax regime. But these 3 deductions, employer's contribution towards NPS, central government contribution towards Agnipath scheme and deduction in respect of employment of new employees is allowed as a deduction. There are few more points which we have to revise under the default tax regime. If there are any losses or any depreciation which is attributable to the deductions we have just discussed now, these above mentioned deductions, they are not allowed to be carried forward for set-off purpose from the earlier assessment years. I repeat again, if there are any losses or any depreciation attributable to the deductions which we have discussed before, they are not allowed to be carried forward from previous assessment years, from earlier assessment years for the set-off purpose. That is what I have mentioned in the notes. Carry forward of losses or depreciation from earlier assessment year, from any earlier assessment year, if such loss or depreciation is attributable to any of the deductions above, is not allowed. Also, if there is a loss under the head house property, it cannot be set off with income from any other head in the default tax regime. Usually under normal provisions of the Act, we can set off any loss under the house property with the income from any other head. But under the default tax regime, if there is a loss under the head house property, we cannot set it off with the income from any other head in the default tax regime. There is one more condition regarding depreciation under the default tax regime. We know that assessee can claim depreciation under section 32, but that depreciation amount is restricted to only 40% of written down value of such block of asset. That means only 40% of written down value of block of asset can be claimed as depreciation and not more than 40%. Remember guys, additional depreciation is not allowed under the default tax regime. Normal depreciation is restricted to 40% of WDV of block of asset, and additional depreciation is not allowed to be claimed as a deduction under the default tax regime. Also, under the default tax regime, assessee cannot claim exemption or deduction for allowances or perquisites which are allowed under any other law. Okay, exemption or deduction for allowances or perquisite provided under any other law is not allowed as deduction under the default tax regime. Now let us go through one illustration. Mr. X has a total income of rupees 16 lakh for the previous year 2023-24. Compute his tax liability for assessment year 2024-25 under the default tax regime under section 115 BAC. We know that up to rupees 3 lakh, the tax rate is nil. So the tax is leviable from the income which exceeds rupees 3 lakh. Up to from 3 lakh rupees to 6 lakh, the tax is charged at 5% on the amount in excess of 3 lakh. That is, on 6 lakh minus 3 lakh, 5% of tax is charged, which amounts to rupees 15,000. Similarly, for total income exceeding 6 lakh up to rupees 9 lakh, the tax is charged at the rate of 10%. 9 lakh minus 6 lakh is equal to 3 lakh. On this 3 lakh amount, 10% tax is charged, which amounts to rupees 30,000. Similarly, from for total income exceeding 9 lakh up to rupees 12 lakh, the tax is charged at 15%, that is 12 lakh minus 9 lakh, which is 3 lakh. On this 3 lakh amount, 15% is charged, which amounts to rupees 45,000. For 15 lakh minus 12 lakh, that is 3 lakh again, 20% tax is charged, which amounts to rupees 60,000. And for total income exceeding rupees 15 lakh, in our case, the total income is 16 lakh. So 16 lakh minus 15 lakh, that amounts to rupees 1 lakh. On this 1 lakh amount, tax at the rate of 30% is charged, which amounts to rupees 30,000. Adding up all these amounts, we get a total of 1,80,000 rupees. For this rupees 1,80,000, we add health and education cess at 4%, which is rupees 7,200. So the final tax liability of Mr. X is rupees 1,87,200. Having discussed the tax rates under the default tax regime, the deductions or exemptions which are not allowed under the default tax regime, and after discussing one illustration on how tax is computed under the default tax regime, let us now revise the tax rates which are charged under the as per the normal provisions of the Annual Finance Act. For individuals, HUF, AOP, body of individuals, or artificial juridical person who has opted to shift out of default tax regime and pay tax as per the normal provisions of Annual Finance Act, the tax rates are as follows. If the total income is up to rupees 2,50,000, the tax rate is nil. For total income exceeding rupees 2,50,000 up to rupees 5 lakh, the tax is charged at 5% of total income minus rupees 2,50,000. That is, the excess of rupees 2,50,000 is chargeable to tax at the rate of 5%. Next, for total income exceeding 5 lakh up to rupees 10 lakh, the tax is charged at 20% of total income minus 5 lakh plus rupees 12,500. The 12,500 comes from the previous slab, that is the 2,50,000 to 5 lakh rupees slab. Then for the total income exceeding rupees 10 lakh, the tax is charged at 30% of total income minus 10 lakh. That is, total income minus 10 lakh, on this amount, the 30% rate is levied, plus rupees 1,12,500 from the previous slabs is also added. Let us revise once again. Up to 2,50,000, the tax rate is nil. For total income exceeding rupees 2,50,000 up to rupees 5 lakh, it is 5% of total income minus 2,50,000. For total income exceeding rupees 5 lakh up to rupees 10 lakh, the tax rate is 20% of total income minus 5 lakh plus rupees 12,500. For total income exceeding rupees 10 lakh, the tax is levied at 30% of total income minus 10 lakh plus rupees 1 lakh 12,500 is added. Now, for resident individuals who are of age 60 years or more, that is for senior citizens, the tax slab rates are different. For them, up to rupees 3 lakh, the tax rate is nil. But for total income exceeding rupees 3 lakh, up to rupees 5 lakh, the tax is charged at 5% of total income minus 3 lakh. So for senior citizens, the basic exemption limit is 3 lakh. Then the next slab is if the total income exceeds rupees 5 lakh and it is up to rupees 10 lakh, the tax is charged at 20% of total income minus 5 lakh plus rupees 10,000 is added from the previous slab. Then if the total income exceeds rupees 10 lakh, the tax is charged at 30% of total income minus 10 lakh plus 1 lakh 10,000 from the previous slabs is added. Okay, for senior citizens, the basic exemption limit is 3 lakh. So up to 3 lakh, no tax is charged. If the total income exceeds 3 lakh and it is up to rupees 5 lakh, the tax rate is 5% of total income minus 3 lakh. And if it exceeds 5 lakh and it is up to rupees 10 lakh, the tax is charged at 20% of total income minus 5 lakh plus rupees 10,000 is added. For total income exceeding rupees 10 lakh, the tax is charged at 30% of total income minus 10 lakh plus 1 lakh 10,000 is added. For super senior citizens, again the tax slab rates differ. For resident individuals who are of age 80 years or more, for them, the basic exemption limit is 5 lakh. So up to 5 lakh of total income, no tax is charged. The tax rate is nil. If the total income exceeds 5 lakh and it is up to rupees 10 lakh, then 20% of total income minus rupees 5 lakh is chargeable as tax. If the total income exceeds rupees 10 lakh, then 30% of total income minus 10 lakh plus rupees 1 lakh is added. I repeat, for super senior citizens, that is for resident individuals who are of age 80 years or more, the basic exemption limit is 5 lakh. So no tax up to the total income rupees 5 lakh. If the total income exceeds 5 lakh and it is up to rupees 10 lakh, 20% of total income minus 5 lakh is charged as tax. If the total income exceeds 10 lakh, then 30% of total income minus 10 lakh plus rupees 1 lakh amount is considered as the tax payable. Remember guys, the basic exemption limit of 3 lakh or 5 lakh, this difference is only for individuals and who are resident in India. Now let us go through one case. Suppose Mr. A's 60th birthday falls on 1st April 2024. Then he would be considered to have attained the age of 60 years in previous year 2023-24 itself, and he will be eligible for higher basic exemption limit of rupees 3 lakh. So there is a CBDT clarification regarding attaining of prescribed age of 60 years or 80 years on 31st March itself in case of senior citizens or super senior citizens whose date of birth falls on 1st April. So here Mr. A's 60th birthday falls on 1st April of 2024. So at the time of filing of return for the previous year 2023-24, in the assessment year 2024-25, he will be considered to have attained the age of 60 years in the previous year itself. So he is eligible for higher basic exemption limit of rupees 3 lakh. Suppose if Mr. A's 80th birthday falls on 1st April 2024. So he will be considered to have attained the age of 80 years in the previous year itself, and he will be eligible for higher basic exemption limit of 5 lakh. Coming to our next topic, that is special rates of tax in respect of certain types of incomes. Usually, tax is charged on total income of the assessee as per the rates prescribed under default tax regime or under the normal provisions of Annual Finance Act. But for certain types of incomes, special rates of taxes are levied. What are those incomes? Number 1, under section 111A, short-term capital gains in respect of transfer of equity shares in a company, unit of equity oriented fund, or unit of business trust. On such short-term capital gains which are earned on transfer of equity shares in a company, units of equity oriented fund, or units of business trust, 15% tax rate is levied. But there are certain conditions which are to be fulfilled for this 15% rate of tax to be levied on such short-term capital gain. Those conditions are: number 1, the date of sale should be on or after 1st October 2004, and STT, that is Securities Transaction Tax, should be charged. I repeat again, on transfer of equity shares in a company, units of equity oriented fund, and units of business trust, the assessee has earned some short-term capital gain amount. On such amount, 15% tax rate is levied only if STT is paid, and at the same time, the date of sale should be on or after 1st October 2004. Next, income, that is long-term capital gains, which are other than those taxable under section 112A. So what section 112 says is, the long-term capital gains which are not taxable, other than those taxable under section 112A, are taxable at the rate of 20%. Let us go through what are the long-term capital gains which have arisen under the section 112A. Under section 112A, on transfer of equity shares in a company, unit of equity oriented fund, or unit of business trust, if long-term capital gains are earned by assessee, then such amount is taxable at the rate of 10% if it exceeds rupees 1 lakh. That is, long-term capital gains up to rupees 1 lakh is exempt. But if it exceeds rupees 1 lakh, the amount is taxable at the rate of 10%. There are certain conditions which are to be satisfied for this 10% tax rate to be applicable on such long-term capital gains. What are those conditions? Number 1, the STT should have been paid at the time of, in case of equity shares, the STT should have been paid at the time of acquisition and transfer. So, a long-term capital gain has been earned by assessee by transfer of equity shares in a company. If he has to get the amount taxed at the rate of 10%, he should have paid STT at the time of acquisition of those shares and at the time of transfer of those shares. Only if he has paid the STT at the time of acquisition and at the time of transfer, he can get the amount of LTCG, that is long-term capital gain, taxed at the rate of 10%. The second condition, on the units of equity oriented fund or units of business trust, only at the time of transfer the STT should have been paid. If the STT is paid at the time of transfer only, that condition is enough for the assessee to get the amount of LTCG, that is long-term capital gain, taxed at the rate of 10%. And also remember this condition again, the LTCG up to rupees 1 lakh is exempt. But if it exceeds rupees 1 lakh, it is taxable at 10%. That is, the long-term capital gains which have been earned by the assessee on the transfer of equity shares in a company, units of equity oriented fund, and units of business trust. If the amount of long-term capital gain exceeds rupees 1 lakh on transfer of such units, then the tax is charged at the rate of 10%. If it doesn't exceed rupees 1 lakh, the tax is exempt. For all the long-term capital gains other than those mentioned now under section 112A, the tax rate will be 20% as per the section 112. Okay. Next income is winnings from lotteries, crossword puzzle, races including horse races, card games and other games of any sort, gambling, betting of any other form or nature. On such winnings, 30% tax is charged. Under Section 115BB, winnings from lotteries, crossword puzzle races including horse races, card games and other games of any sort, gambling or betting of any form or nature is taxable at the rate of 30%. Next income is under Section 115BBJ. Net winnings from online games. Any winnings from the online games, net winnings from the online games is taxable at the rate of 30%. Next income under Section 115BBE. Unexplained money, investments, expenditure, etc. deemed as income under Section 68, 69, 69A, 69B, 69C or 69D is taxable at the rate of 60%. But the conditions are: no basic exemption or allowance or expenditure is allowed while computing such income. Then, no set-off of loss is allowed on such income. On unexplained money, investment or expenditure, the first condition is when we apply the tax rate of 60%, no basic exemption or allowance or expenditure is allowed. Then, no set-off of loss is allowed on such income. Apart from 60% tax rate, a surcharge of 25% and a cess at the rate of 4% on tax and surcharge is charged. That is, on 60% on the amount of unexplained money or investment or expenditure, the tax is levied at 60%. On such amount, again we add surcharge at the rate of 25%. After adding surcharge, we arrive at the amount on which cess at the rate of 4% is charged. The effective rate would be 78%. So guys, these are the special rates of taxes which are levied in respect of certain types of incomes. Now let us discuss the next topic, surcharge. What is surcharge? Surcharge is nothing but the additional tax which is payable over and above the income tax. That is, usually we after computing the income tax as per the default tax regime or as per the normal provisions of the Annual Finance Act, additional tax on such amount is payable. So the additional tax payable over and above the income tax computed is called surcharge. And the surcharge is not applicable for all the assessees. The surcharge is applicable only if the total income of the assessee exceeds certain threshold limit. So what are those limits? For individual, HUF, AOP, body of individuals or artificial juridical person who are opting to pay tax under the default tax regime of 115 BAC, if their total income exceeds rupees 50 lakh, the total income includes, here I have written 1 and 2. The 1 and 2 is nothing but 1 means dividend income and 2 means capital gains taxable under section 111A, 112, 112A. The total income including 1 and 2 dividend income and capital gains taxable under section 111A, 112, 112A. If it exceeds rupees 50 lakh but is less than or equal to rupees 1 crore, the total income including 1 and 2 has increased rupees 50 lakh but is less than or equal to rupees 1 crore, then the surcharge is at the rate of 10%. For example, if the income from 1 and 2, that is dividend income and capital gains under section 111A, 112 and 112A, if it exceeds, if it is rupees 75 lakh and other income other than the dividend income and capital gain income, the income is rupees 25 lakh. In such case, surcharge at the rate of 10% on total income of rupees 1 crore is charged. Here, the total income is aggregating to rupees 75 lakh plus rupees 25 lakh, that is rupees 1 crore. So, surcharge is applied at the rate of 10% on the total income of rupees 1 crore. Next, if the total income including 1 and 2 has increased has exceeded rupees 1 crore, but is less than or equal to rupees 2 crores. Then surcharge is applied at the rate of 15%. For example, the income from 1 and 2 is rupees 1.3 crore. The other income is rupees 55 lakh. In such a case, surcharge at the rate of 15% on total income of rupees 1.85 crore is charged. I repeat again, guys. The total income including 1 and 2 has exceeded rupees 1 crore, but it is less than or equal to 2 crore. Less than or equal to 2 crores. In such a case, 15% surcharge is levied. Here the income from 1 and 2 is rupees 1.3 crores, whereas other income is rupees 55 lakh. In such a case, the total income is aggregating to rupees 1.85 crore. It is less than 2 crores. So the surcharge is levied at the rate of 15% on total income. Next, total income excluding 1 and 2. Excluding 1 and 2 is exceeding rupees 2 crore. In such a case, surcharge will be at the rate of 25%. And the rate of surcharge on 1 and 2. Here we have excluded 1 and 2 and we are charging the surcharge at the rate of 25%. In such a case, the rate of surcharge on 1 and 2 will be not exceeding 15%. For example, income from 1 and 2 is rupees 1.92 crore. The other income is 6 crore. The total income has exceeded rupees 2 crores. In such a case, look at this, guys. The total income excluding 1 and 2 has exceeded 2 crores. That is, excluding 1 and 2, the other income is rupees 6 crore. In such a case, we charge this, we levy the surcharge at the rate of 25% on other income. That is rupees 6 crore. And the surcharge on 1 and 2, that is on rupees 1.92 crores, will be at the rate of not exceeding 15%. Let us take 15% here. Next case, the total income including 1 and 2 has exceeded rupees 2 crores. In such a case, the surcharge will be levied at the rate of 15%. For example, income from 1 and 2 is rupees 1.67 crores. And the other income is rupees 1.1 crore. Both the income from 1 and 2 and the other income are less than 2 crores. But when aggregated, it is exceeding 2 crores. That is rupees 2.77 crore. In such a case, the surcharge is levied on the total income, that is rupees 2.77 crore, at the rate of 15%. Let us repeat these rates again. For the total income including 1 and 2, if it exceeds rupees 50 lakh but less than or equal to 1 crore, the total income including 1 and 2 exceeds rupees 50 lakh but it is less than or equal to rupees 1 crore. In such a case, the surcharge is at 10%. For total income including 1 and 2 exceeds rupees 1 crore but is less than or equal to rupees 2 crores, the surcharge is 15%. For the total income excluding 1 and 2, the total income has exceeded rupees 2 crores. Then the surcharge will be 25%, and for the rate of surcharge on 1 and 2 will be not exceeding 15%. The total income including 1 and 2 has exceeded rupees 2 crores. In such a case, the surcharge will be 15%. These are surcharge rates under the default tax regime. Now, coming to the surcharge rates for individual, HUF, AOP or body of individuals or artificial juridical person under the normal provisions of Annual Finance Act for those who have opted out of default tax regime. For such assessees, the surcharge rates are as follows. Here the same 1 and 2 means 1 means dividend income and 2 means capital gains which are arising under the section 111A, 112 and 112A. So for total income including 1 and 2, if it exceeds rupees 50 lakh but is less than or equal to rupees 1 crore, the surcharge rate will be 10%. For example, the income from 1 and 2 is rupees 65 lakh and other income is 25 lakh. If we aggregate, the total income would be rupees 90 lakh, which is exceeding 50 lakh but is less than rupees 1 crore. In such a case, surcharge will be levied on total income of rupees 90 lakh at the rate of 10%. Now, the total income including 1 and 2 is exceeding rupees 1 crore, but it is less than or equal to rupees 2 crores. In such a case, the surcharge will be 15%. And for let us see the example. The income from 1 and 2 is rupees 140 lakh, that is 1.4 crores. The other income is 50 lakh. The total income, when we aggregate, amounts to rupees 1.9 crores. It exceeds 1 crore but is less than 2 crores. In such a case, the surcharge will be levied at the rate of 15% on total income of rupees 1.9 crores. Next, the total income excluding 1 and 2. So, without the income from 1 and 2, the total income is exceeding rupees 2 crores but is less than or equal to rupees 5 crores. The total the income from other than 1 and 2, the other income from the other income has exceeded rupees 2 crores but is less than or equal to 5 crores. In such a case, the surcharge will be 25% on such income, and the rate of surcharge on the incomes from 1 and 2 will be not exceeding 15%. So, income from 1 and 2 is rupees 1.92 crores here. The other income is 3 crores. The other income has exceeded 2 crores but is less than 5 crore. In such a case, 25% will be charged on such 3 crores amount, and for the income from 1 and 2, the surcharge will be at the rate of 15% only. Next, the total income excluding 1 and 2. So, other than the income from 1 and 2, the other income part has exceeded rupees 5 crores. In such a case, surcharge will be 37%. And the rate of surcharge on 1 and 2 will be not exceeding 15%. Simply put, for example, if the income from 1 and 2 is rupees 177 lakh, that is 1.77 crore, the other income is rupees 6 crore. Here the other income has exceeded rupees 5 crore without the inclusion of incomes from 1 and 2. In such a case, the rupees 6 crore amount will be charged at the rate of 37% surcharge, and 15% surcharge will be levied on rupees 177 lakh, that is income from 1 and 2. Next case, the total income including 1 and 2 has exceeded rupees 2 crores, and the cases are not covered in the points mentioned above, 3 and 4. In such a case, the surcharge will be 15%. For example, the income from 1 and 2 is rupees 192 lakh and the other income is 1.1 crore. Here, the total income including the other income and income from 1 and 2 has aggregated to rupees 3.02 crores. Individually, the income from 1 and 2 and the other income are less than 2 crores. In such a case, the surcharge at the rate of 15% is charged on total income of rupees 3.02 crores. In the same way, we have next example where the income from 1 and 2 is rupees 6.9 crores and the other income is rupees 0.1 crore. So, including the aggregate amount of income from 1 and 2 and other income has amounted to rupees 7 crore. Otherwise, the other income is less than 1 crore. In such a case, the surcharge at the rate of 15% of on total income of rupees 7 crore is charged. Once again, let us revise these surcharge rates under the optional tax regime. That is, for the total income including 1 and 2 exceeding rupees 50 lakh but is less than or equal to rupees 1 crore, surcharge is at the rate of 10%. For total income including 1 and 2 exceeding rupees 1 crore but is less than or equal to rupees 2 crore, surcharge is at the rate of 15%. For total income excluding 1 and 2. For total income excluding 1 and 2, which exceeds rupees 2 crore but is less than or equal to 5 crores. Surcharge is at the rate of 25% and the rate of surcharge on 1 and 2 will be not exceeding 15%. The total income excluding 1 and 2 exceeds rupees 5 crore. Then the surcharge will be at the rate of 37%. The rate of surcharge on 1 and 2 will not be exceeding 15%. For the total income including 1 and 2, if it exceeds rupees 2 crores, for the cases which are not covered under the 3 and 4, the surcharge rate will be at 15%.